Morgan Stanley cuts its gold forecast and says there's even more pain to come. We'll get Peter Hugg's thoughts next. Joining me this Wednesday is Peter Hugg. Peter, thanks for being back with us.
You're welcome, Daniela.
Peter, let's start with your favorite topic, bank forecasts. Morgan Stanley now cutting their 2014 target for gold by 12% to $1,160 an ounce. What do you make of this announcement? They also say that there's might be more pain to come.
Well, they're either going to be right or they're going to be wrong. I mean, when you look at the banks making their forecasts, the banks are making their metals forecasts based on factors that are non-fear related, non-geopolitical related, and certainly no catastrophic events occurring. They're assuming that the U.S. economy does have legs, will be able to withstand the taper, and that the worst is behind us, which takes a large element out of the metals trade, which was the fear component that we saw through 2008 through 2011. But they're basing this on an economic recovery with interest rates gradually working their way higher throughout 2014, which creates a scenario where gold, a non-performing asset, doesn't have the allure that it had, in just this recent cycle over the last, the 2008-2012 cycle. So in that context, gold prices lowering throughout 2014 would be a consistent conclusion based on their premise. The question is their premise accurate?
So Peter, we're basically seeing little fuel in the market to create new momentum here. What's a key target you're looking at for gold?
Well, I've been looking at 1255 being breached on the upside with some momentum, and it's just not been able to do it. It's tried 3 times. I think it was a couple of days back I suggested this. It could be a trap, and I'd rather pay up for the metal and see the breach and see some momentum come in after a 1255 breach on the upside to have any conviction to take an aggressive long position here. It paid off. It bounced off 1255, and this morning we're seeing it at minor support at around 1237. It's not huge support, but it has bounced off here a couple of times. But given no fuel coming into this market, nothing to surprise this market. The market feels heavy, and once the traders try to push through one side and they can't get it, they'll try the other side. So if we lose 1237, I would suspect 1232, again, a minor support level would be tested. If we breach that, gold needs to hold 1218. Otherwise, we may see the big figure again in short order.
Peter, could we see any surprises come for the metals with the South African strikes that are set to begin tomorrow?
Again, a lot of the South African situation has more of an impact on the PGMs. I still think platinum relative gold is overvalued. Again, on the assumption that this platinum strike will go the way of most other strikes that have occurred in South Africa, which means that it'll be short-lived and they'll get back to work. On that premise, I think platinum is overvalued relative gold. Should this strike continue to linger and then be followed by violence as these mine workers now don't have any money, there could be considerable upside in the PGMs. Short term. Medium term to long term, we've always liked the PGMs relative gold. The supply fundamental situation is definitely in favor of stronger PGM prices, platinum, palladium, and rhodium throughout the balance of this year.
Also bullish on the PGMs, Peter, is famed newsletter editor Dennis Gartman. He's very bullish on palladium, not so much on gold, though. He just announced he reduced his exposure a bit. What do you make of his thoughts?
Well, again, I'd want to know why he reduced his exposure in gold, and if it's premised on similar logic that has been forthcoming from the banks, that he expects a stronger U.S. dollar because of a stronger U.S. economy. I certainly agree with him that you might want to lighten up on your gold position because in that scenario, I do see gold sort of working its way lower, at least through the first half of this year. On the PGMs, I can't argue with his logic. I mean, palladium is in a supply deficit situation. So again, if the logic of his argument on gold is accurate, that he sees gold weakening because of a stronger U.S. economy and generally stronger global growth, you would expect that there would be more demand for the PGMs, palladium and catalytic converters for cars if Europe starts to pick up in a market where supplies are in deficit for palladium. So in that scenario, $1,000 an ounce is certainly a logical assumption.
On that note, thanks so much for being with us, Peter.
You're welcome, Daniela.
And thanks for watching this edition of For Pete's Sake. Email us at newsfeedback@kitco.com or follow me on Twitter at Daniela Cambone. Thanks for watching.